Hey, how are you guys? It's the Market Sniper. Market Sniper again, yes. We're also the Crypto Sniper and the Reset Sniper. We've been talking a lot of reset on the channel as well with the live streams. This is a technical one. This is to do with the charts. And this has got to do with a number of theories that we've been banging on for a long time that seems to be coming to potentially their final point. So history of oil, literally from when I began trading stroke investing, 1987, very young. Very wet behind the ears, jumped into the stock market at the top basically and got handed a 40% loss. But this isn't the stock market, this is Western Texas Intermediate crude oil, or US oil for most people, best understanding. Now what you'll notice, short history of the oil price from 84. From when I have history on this chart, it goes from earlier actually. Oil bounced around between $12 essentially, and on the high side 25, going to a top roundabout just through 32.5. So I've put two blue lines of 32.50 there and 12.25, which just about encapsulated for that entire era. And I'm talking down here. Let's get the drawing pin out. This entire era of decades through to here. You were encapsulated in that with a mean point in and around of the $22, $25, $22.50 area. That was your range. However, as we clear that out now, what subsequently happened is we started to get a little bit of an ascending wedge structure. We teach about this in our training. You can get a free mini series below and you can learn a whole bunch more as part of our being a student in our community. But what essentially was happening is that there was a bit of squeezing up from here. This started around the 2000s and the millennium. That's right. Started in and around the post-millennium. We had a pump to the highs of millennium. We had a little bit of a downdraft in the millennium post the dot-com boom, which was economically weak. So that saw a sell-off come. That established essentially the base of our wedge that subsequently broke. And note it broke to the upside. And many traditional technical analysts will be shock and horror because they teach that rising wedges should fall to the bottom. And what actually happens is it's a volatility based event. That's part of that Market Sniper, that little Nautilus shell. It's the method. It's understanding that this was a volatility constriction. And in fact, a very vast, expansive move was coming. And in many instances, it can be a blow off down to the downside and almost what many would describe as a reversal event. But it can also be if these green arrows are just the advanced party of a huge moon phase, in other words, the beginning water flows of a huge tsunami coming in. It can actually be a melt up out the top, and we refer to that as a type 3. You'll learn more about it, just book in for a call below. Anyway, you got the subsequent move in oil that was vast, a little bit of a comeback and stroke 05, 06, and then wham, right up there. Really big move, and you topped out just shy of $150, I think around 147 on WTI. Then, since then, we were big bear callers on the failure when the Russia and the Ukraine issue was happening, for the failure for oil to run beyond 115 at that point. We were big bear callers and we called oil short really early and said it's going to be expansive to the downside. It was a first inverted HVF in a new trend. Note this, whoops, let's change that, get rid of that. Let's get an arrow instead. Note this, what we refer to as a grind line. You'll learn about our method in a later if you choose to come on board, but essentially you get your first structure in a new trend to the downside. And we said you're going to get extreme overperformance. We got even further extreme overperformance than we were ready to trust would happen, and you came really low, and at the end of, after a small rally here, at the end you traded right down below the previous low. Now it's quite interesting at these points to highlight this previous low, because guess where that bounced? Well, it bounced right there on the previous roof, the tin roof of our existing range. Recognize that that existing range was just run a few times in the wedges here and there as well. So you always test and just run in the same way that we did make slightly lower than $12.25 a couple of times. Then you got your squeeze up. This is a key moment. Bounced all the way back up. This is essentially a depression, guys. The system was due to fail, should have been allowed to fail, and wasn't. You all know about 7 and 8. That's all this time span over here. But they created so much new money. And then good old Obama, who was picking up the pieces from George W., gave all the fracking licenses out, etc., etc. Big industry again, and off we go. Anyway, down, and this low over here actually ran the previous low, and then only then, after the lows of 216, which was when China was all gassed out. They were the buyers of last resort. They were the green arrows that came in and gave us this grind line in a period when the Western world was on its knees and doing QE, complete depression. They provided heat in the economy and they bought commodities from everywhere. They kept Canada inflated, they kept Australia inflated, and part of the Western world got a little bit more heat in the room as a result of that buying. Boom, 15 into the beginning of 16, the end of them, they are totally gassed out on debt. So now we have a globe of big nations all over indebted. That's your narrative. But during that period, don't worry, we'll keep a weak dollar because China de facto pegged to the dollar. What actually happens? We reflate oil somewhat, QE policies, etc. We get a small reflation and we're back to the other side of what is a huge macro falling wedge, by the way. So I'll refer back to this as well. Look at that huge macro falling wedge. Like that. I'll take those two lines off for now. You know what I'm talking about if I refer to it. So anyway, so this is our narrative. I'll take a picture for this. I'll tweet it out for you guys if you want to remember this particular explanation of the overall macro. I'm going to bring you into where we are today in the more near term. So that was your macro view according to Francis in a summary sense. So let's take it off. We'll grab a quick snap for you and you can have that for your records if you enjoy charts and the explanation that went with it. Okay, good. So now I'm going to go back to the chart and I'm going to take you down into the lower time frames and we're going to clear this. Thank you for popping up twice. Let's see if you can go away now. It really wants to stay. There we go. So let's clear the screen. Boom. And let's tell you what happened next. So we're going to go into a structure that we refer to as inverted HVF. And I'm going to show you actually a draw that we did that I discussed and shared with all our premium guys in terms of our view of the market. But I'm going to take you in there slowly. We'll first drop into the weekly. In fact, that's probably the view I'll stay on for now. Get rid of some of that history. And pick this up and bring it into the middle of the chart. Okay, so that was your final low after you ran the depression, in my view, of 2008-9 lows. You actually ran that depression lows in the 15-16 period with China gassed out. So the rest of the world had a little bit of a chance at recovery. Remember the amount of times they called green shoots, green shoots, green shoots, only it was more like bamboo torture. But anyway, we never quite recovered, but we did get some time. China then gassed out, and next thing you know, we have another rising wedge structure. Again, if I scribble for you with my little drawing tool, every child likes a crayon, and I'm no different. So here we go. So in we came, a little bit more of buying coming in, and then it started to get ragged. It's starting to get ragged. Think of the ragged tooth shark. Yes, sir. Dangerous bastard, by the way. Getting a bit ragged, and you have this top over here, and these many intersection points over there. Boom, again, a mini spiller. We were trading a small version of this sell-off, and we got some of it. It kept coming, but it stopped. It stopped at that point. It base plated before clearly running that low, and then we got into a bit of a holding pattern. And for us, this was a pause. In other words, we've been macro bears, been talking about how fracking was quantitative easing. The government was actually backing, standing behind banks that were financing a sub-economic activity, a not-for-profit trade. And that's straight away a problem. But it was there to put pressure on the likes of Venezuela, Iran, Russia, and all nations they didn't always consider in the light that they most wanted to be supportive of. So it was handy having non-financially viable oil production in the US, and of course it brought some jobs in. So we had this structure, and then we drew for ourselves an inverted HVF. The target, as I've always known, and my community has always known, and I now reveal to you for this, is through the 8 level, 7.96. This purple line you see here is the geometry that we've created. So we will test $8 level for crude production. Now, we were short on this fading star quite early on in these levels around here. We got taken out on our stops, so it wasn't all easy. We didn't get it all 100% right with the big drone incident. I don't know if you remember the drone incident, a desperate attempt to pump. We were shaken out, and again, I got back in short. Glutton for punishment. When I smell a trade, I don't let a little bit of deception and a little bit of chicanery throw me out. I'm determined to stay in. You rarely get the first entry absolutely right on a major global macro trade. You have to man up. If your view is there and you have confidence in it, you stay with it. These 3 lows were super critical. These 3 lows were super critical. Here, here, and there. I should use the square. For some reason it didn't want to come. There we go. That little low, that little low, and that little low. And I was going to be super confident when we ran that. We started to spill. We broke this grind line. This is what we call them. As I say, you'll learn about them. They're not trend lines. That would be erroneous for you to even suppose that they are. And they serve a totally different purpose in terms of that which we do. And we were short literally from there, repeating, as I repeated many times during this period, that my suspicion is single digit is a distinct possibility on here. It wasn't an out and out 100% that's going to happen. Nobody knows the future. You should never use language like that. But it was a high probability possibility that many didn't see as having any probability for us. But it was a bit out there to go out and say, it's totally high probability. It's saying, listen, you guys are underpricing the scope for single digit oil. And that has been the key message that we've made, particularly on WTI. So let's drop a time frame and talk a little more about this as it's built. By the way, that's your entry. I covered most of my trade on the oil and my oil services shorts near these lows. In other words, I'm not claiming to carry it all the way through to the 7.96. Why, you might say? Because it was a disproportionate draw slightly. You'll learn about what we talk about. They often happen and they often perform, but the degree of confidence is slightly lower. That's why I was saying it is an underpriced possibility that this certainly has a decent chance of occurring that no one is even talking about. Let's be clear. WTI was trading in the 60s, went through 64, traded $65.63, and someone came out and said, shortly, this could actually trade below double digits, in single digits, faster than people realize, and it's an underpriced event. And we repeated that at the Dollar Vigilante as well as on many other videos that I did. And in fact, the big fall that occurred on the Monday, I live tubed on that Sunday saying, once again, I think there's real facts that the Saudis having fallen out with the Russians going to lead to a gap trade event, which is exactly what occurred. The biggest drop in oil that most people...
So those 3 yellow areas that I'm highlighting are what I anticipate will happen next for oil, potentially even a new low to the previous low. I've gone so far to say, and this is trying to be controversial maybe, but I'm saying people are underpricing possibility. They're underpricing. That doesn't mean it's high probability. Underpricing means you might think it's 0.0001%, and I think it's 5%. That's an underpricing of single digit oil. That's not a prediction, but I think it's being underpriced. Fracking is getting way more efficient, unfortunately.
So there I said quite conservatively, because I was on a stage in front of a lot of people, that it's underpriced the fact that single digit oil is a distinct possibility. In fact, I've been more vociferous, as I am normally on my YouTube channel, when unhindered by audience responses and ahs and oohs, and this video is on YouTube along with many others from that period, which highlight the call for potentially single-digit oil in that. And we have a target, and I've given it to you. It's at the $8 level, which could see the $8 level just be run. So you could actually see, never mind single-digit, 9.99, you could actually see something starting with a 7 within all of that, which might mean a part of an overreaction to the downside. So this is the power of real, true method as far as we are concerned. This is the potential of it. This is your trade line of efficiency. You'll learn what we mean by a line of efficiency. By the way, it's how much good green profits do you get in how short a time. And by the way, shorts just work out faster and better and quicker than longs typically do. Why? Because most of the time markets spend their time going up. And also when you have shorts, you're actually calling real calamity. It's not by accident that we have continued to assert that a great global reset is going to be enforced upon us, and that your operators in chief and string pullers will be bringing this global economy down, and this is one of the vehicles whereby it would come. Also of note, as a key level that you may notice that we are currently at now, which might prove a pause point actually, is the previous channel lows, the 1225. So I spoke of the 3250s and the 1225s. Your legacy history, and these are in much diminished dollars in light of how much proliferation has gone on. Your legacy history range from those late 70s into early 80s all the way through until just around the very late 90s and the run into 2000, when that first rising wedge took you to the stratosphere. And this is where the global powers that be extracted with full power the profitability that was theirs. We had huge oil companies as being the biggest market cap companies, or close to the biggest market cap companies, at the $150, approaching the $150 oil market. There was profit for everyone. And who were the big owners? Go check the shareholders on your various Shell, Royal Dutch Shell, BP, etc., Xenon, Exxon, I should say, which of course was part of the old Standard Oil Rockefeller crowd. So what might happen? You may get a bit of a reaction having run this legacy level of 1225. It's quite a significant area, but I still suspect that there's a decent chance that we will see the 796 that we've suggested target be run to the downside on what was a disproportionate but still significant inverted HVF. We were highly confident that we would return to the bottom edge of the wedge, which is where I've taken the bulk of my profits. Believe you me, when you are sitting and you've been short from just after the drone strike at levels up there, that's our Turkish lira, by the way, that keeps beeping. You can see we use alerts. I certainly suggest you use them too. You can see that if you're short from there, you do not risk your mega holdings against a bit of a whiplash and a major deal, even if you're not too far away, because you've got more to lose on the downside. We stick to process generally, but there will come a point where if you've got too much in it, it's worth taking partial profits, and that's where we took the bulk of our partial profits. We also had PAA meet its target at that time. I still expect it will overperform after a while, but we had a feeling there'll be some pushback at it. It's exactly what's happened. If we have a look at the likes of PAA, which set up structure. So when this trade is, and I've done a lot of YouTubes on this, so this will be the last one in and around this. You can see how it's rallied since running our target 327. It's still up there at 713 in spite of oil's recent performance. So we had a lot of targets confluencing at that juncture point. There was Tullow as well that some of the UK folks would have been involved in, and of course it's also listed. It also had a rally there at these points. These are key trade moments that were occurring and that we were trading. And when you have a confluence of all targets, history has told me it's a good reason to potentially get out at those levels and at those points. Okay, so overall, I still expect maybe a little bit of a reaction at the 12 mark, but at some point you could in fact see sub $8 on the US oil, as this has done so well towards making this target. It's difficult to see that it's not got a decent shot of finishing the job. It is basically 4 $4 away. $4, in fact, let's get the correct number, $12.25. It's $4.26 away from trading sub $8. And it is $2.26 from trading in the single digits, as forecast when it was $65, 3 weeks before the massive gap. Although it was forecast before, it was reiterated on that video. That's the power of real method. And if you can see the value in that, if you can say, wow, I really want to do that, then you can come and join us and be part of our community in and around that. You could be in our Turkish lira trade. This is an inverted chart. If you're looking a bit confused, you can be grab our mini series. If you don't want to take it any further, just grab our mini series and have a look at what we're all about. But the possibilities of trading with HVF method and the possibilities of single digit oil are being illuminated right here in front of you. And this is a real spiller, literally from the $65 mark, and as I suspect, probably sub $1. Okay, catch you all later, and thanks for watching, and we'll have some more trade ideas for you. But if you want to get on them right at the beginning, there's only one way to do that. You've got to be in our community to do that. But I hope still to help some of you make some money free once the moves are well established and we're ready to go public with them. All the best to you all. Trade small, trade safe, and by the way, this is not an inducement on our behalf to do anything of a financial trading nature. It's not always good for all personality types. We're not regulated in any way. Bye for now.